this lecture that we are going to do today is going to be on GST. So what essentially we're going to do is we are going to study the concept of GST, the evolution of GST from the history of it, that since independence, what has been the evolution of GST over the years. Then what we are also going to see is that how GST we'll see a numerical and how GST is superior to all the other versions that we use. So this is going to be a little longer video because of the fact that we need to cover the basics before we get into the actual essence of the practice in which we followed the GST model in India. So now that we have the GST system with us, we need to understand that how GST is different from the previous systems that we used to. For that, let's first go through the first of all let's go through the definition of GST. Now, as I can understand, I don't expect you to learn this definition, but at the same point of time, what I expect you to do is understand each and every term. So GST essentially is a comprehensive multi-stage destination based consumption tax, and this consumption tax is on value. This is the technical jargon. Now, as I've told you in classes, like I told you that what economists do is that we make jargons, and one of the purpose of having jargons is that the layman would not be able to understand. So my purpose of these classes is to unravel. So by the time we end our class, I want you to understand this definition so that you don't need to mug it up. You can by your own self, you can analyze that what this tax is going. Even before we get into the definition of this tax, let's go into the constitutionality of how taxes are divided. Now, we have already done the budget section, so you already know that taxes in India are divided into, you have direct taxes and you have indirect tax. Now, these indirect tax is what we are going to talk about, because you know the difference is that here the burden cannot be shifted, where in this case the burden can be shifted. So the imposition on which the imposition person, the person on which the levy is made, and the person who actually pays it can be different in the case of indirect taxes, where in case of direct taxes the burden cannot be shifted. The examples of direct tax is for example corporate tax or income tax, whereby it is on my income, it is on my corporation, it's on my company. I cannot shift this burden to any other. Whereas in case of indirect tax, so these indirect taxes in themselves are further actually in the constitution, in the original sense of constitution, were in two parts. Was those taxes which was collected by the central government, and those which were collected by the state. So these are the two major kinds in which the taxes were divided. Now, if we see the erstwhile picture of the distribution of taxes, the central government in our constitution was authorized to collect and to levy taxes on manufacturing, whereas the final part, the retail part, the sales part, was given to the state government. So the state government's retail on sales. This is how the architecture, the economic architecture of the constitution was. We will understand this economic architecture in detail. In further detail, I'll get into the articles of the constitution as well. But let's go through the basics. These indirect taxes, the problem was that there were too many indirect taxes being imposed by the central government and by the state government. There were too many of them. So if we see these taxes, and if we see the taxes which is imposed by the union government, the central government, these lists were first being excise duty. Now, excise duty is also basically called as production. As soon as your factory output, suppose I produce shoes, so as soon as the shoes that I produce leave my factory, there used to be something called an excise duty. So excise duty is nothing but a tax on product. You also have customs duty. I'll tell you, this custom duty is not a part of GST. Custom duty is still there, so GST has not incorporated this custom duty. Just make a note of that. But let's just highlight what all are the taxes which the union government imposes, indirect taxes which the union government imposes. Then you have something called countervailing duty. Countervailing duties is essentially duties that the central government imposes on imports to counter the export subsidies which the other country is giving. So what essentially happens is, suppose India versus China. So China, to make its exports more competitive, kind of fund their exporters. So what, by funding, what they do is that brings down the cost of the per unit cost of their product, and that reduction in cost that has happened is actually paid by the Chinese government. So because of this, their exports will increase. However, if their exports increase, our imports will increase, and if our imports increase, it directly impacts our own domestic production. So to counter that, you have something called counterweight. Then you used to have service tax. Was introduced later in the Indian economy. It was through the 88th Constitution Amendment Act, and this tax was imposed by the union government through the residuary power. I'll explain what the residuary power is. Then you have the central sales tax. Then you also have the additional excise, especially commodities. Remember, I told you the example of how oil price right now in the market, if you compare it to the world oil price, it's somewhere around $30 a barrel, and a barrel has approximately 160 liters in it. If you do the conversion, it'll somewhere go around 25 rupees a liter is the cost of oil. However, what you're paying right now is somewhere around 70 to 75 rupees. So it's because of the fact that oil is one commodity which is heavily taxed both by the central government and the state government. So essentially what happens is, you have the custom duties, you have additional custom duty on that. Then when it goes to the refinery, when it comes out of the refinery, you have excise duty on that. You have additional excise duty on that. So as a commodity, being inelastic in nature, it's being heavily taxed both by the center and the state. You also have taxes in the form of surcharge. Surcharge, as I've told you, is a tax on tax. However, cess is a different kind of imposition, in which cess can only be used for a particular purpose. Moving forward, our other discussion is going to be on the state governments. However, state governments on their part have a different set of taxes which they impose. Now these taxes are the state value added tax, and I'll tell you, this value added tax was introduced in 2005. Before that, you have something called Senvat, and then before that, you had something called Modvat. You had sales tax in case of state governments. So there are many versions of the VAT, the evolution of VAT since independence. So we'll understand the history of it as well. But for now, my concentration is on explaining you the major differences and the transition that happened from VAT to GST. Moving forward, you had taxes like octroi and entry. Is something like toll tax that you pay while you enter a particular state. So if a product is moving from, say, from Rajasthan to Delhi, so at the Delhi border, all these trucks would be stopped, and then they would have to pay an entry tax in form of an octroi, and then these trucks can move in. Now, to eliminate these delays, you have something called as e-way bills. Later on, I'll tell you that this is modified by e-way bill for a smooth run. Essentially, if you see what is the concept, what is the philosophy behind GST, it's one nation. That is the philosophy. and I'll justify how this philosophy is being fulfilled. However, we'll also see that what are the major issues in our GST. So this is the philosophy behind GST. Let us continue our discussion that what is the fragmentation of taxes that used to happen under the erstwhile regime. Then you have entertainment tax. If you used to go to see movies, you would have entertainment tax. Then you have luxury tax, and then you have state. So this was the broad uh, kind of classification of taxes across the country. And if you can see, you have approximately, I've not listed all of them, there were approximately 16 taxes that could have been imposed on a particular. So what happens when all of these 16 commodities or all of these taxes are imposed simultaneously? So the erstwhile system, which is basically before GST, the problem was that you had a complicated GST, you had a complicated indirect tax, too many tax, while alongside you had a huge. Now I'm naming this term for now. Even if you don't understand this, just write it down. There was cascading. We'll understand what this cascading effect is. If you see the word, the nature, the origin of the word comes from geography. If you see rapids, while in the river rafting, you have that cascade effect, and that is because of the fact that there are different layers of hard rock and soft rock, where the running water makes impressions, and then because of that you have these rapids. So these rapids, this cascading effect of falling is basically what we are going to understand. And what we are going to understand is that how GST actually kind of overcomes this effect. So for now, what you can write down is basically cascading is a tax on tax. If you see a rapid, it keeps on moving like this. So that is the tax on tax effect in economic terms, and that's one thing that the GST kinds of avoids. Then you have inflationary impact. The commodities become extremely expensive because of the amount of tax that has been, because of the fact there's too much of tax being imposed. There is always a kind of incentive to not to do black market. So what it does is that because it's a complicated system, the compliance, and because the compliance is low, it will lead to what is called as. These are a few problems with the erstwhile tax system, which was the VAT tax system, or the tax regime that used to be prevalent before VAT used to be there. So these are the issues. Now let's see that how this in a very practical terms, how this used to happen in terms of let's take a numerical. Let's see, and we'll compare that how GST is a little different from the previous system. For the sake of simplicity, I'm taking an example whereby I'm assuming two things. I'm assuming that the tax rate is same, so I'm going to take a 10% tax rate. So my assumptions, let me note it down. My assumptions are: one, that the tax rate is the same across all production phases. Two, right now I'm assuming that there is no profit charged. No profit means that each player is not keeping any profit. Now what you can easily do is you can modify this example, and then using by relaxing both these assumptions, and by relaxing both these assumptions, you can probably understand, you can probably kind of apply what we are going. For your examination purpose, first, what I'm teaching you is not that useful, but you need to understand. See, understanding is our main concern, and after that I'll obviously tell you that this. So let us take an example of making a making a particular commodity. Let's take a shirt. So we are going to see the production process of making a shirt. And a production process, if you see the process of production, this will happen from raw material. This raw material will go to a manufacturer. This manufacturer will use this raw material, make a basic shirt out of it, and then it will supply its product to a wholesaler. The wholesalers, the purpose is of the wholesaler is to probably utilize the warehouse to keep different kinds of shirts, and then sell it to the retailer, and the retailer will sell it out. And I've told you that GST is different from all the previous taxes. GST will be imposed right at the back end of it, because it is a destination based tax. It's a consumption tax, and it's a destination based. Now, this is the process that we are going to do. We are going to understand this in terms. Let's understand this in terms of a numerical of sorts. So for this numerical, let me draw a table. So the kind of table that I want you to draw. Now you have a process. So say let's write down the process in which we are there. Then you have the cost. Then we can also have the tax, and then we have the total amount. So let's take an example. Even if we take it as 100 rupees, it's going to come. Okay, let's take the case of the first production process, and then let's take the first phase where the manufacturer actually takes the raw material from a particular organization. So the first process is the raw. Suppose the raw material that the manufacturer takes is for 100 rupees. I'm assuming the tax rate is constant as 10. This is the assumption that I've taken is at 10%. So 10% on the cost is 110. So tax paid is actually 10, and the total is 100. So when the manufacturer actually buys this commodity, he not only pays 100 rupees, which is the cost, he also pays 10 rupees as the tax which is imposed on the cost of 100 rupees. So what the manufacturer does, the manufacturer, what he's doing is he adds a value of say 40 rupees. That his value addition is 40 rupees. This is the value addition that the cost will be, what will be the cost? The cost will be 100 plus the 10 rupees tax that he has imposed plus the 40 rupees that he has added. This is the cost that has incurred, that the manufacturer incurs on the production of a shirt. I'm assuming that there are no profits. See the second assumption. You can easily change this assumption, and then you can have your own. So ultimately, the product is now at 100. At 150 rupees, the government says that you have a good worth 150 rupees. I have a 10% tax. You need to pay me 15. So the government asks him for 15 rupees. And when this manufacturer actually sells this commodity to the wholesaler, he sells it for, and the nature, you also need to understand the nature of the tax. The nature of the tax here will also change, because this essentially is going to be an excise tax. Remember, I told you that whenever you have manufacturing being done, production being done, the taxation authority is the central government. So production tax is appropriate by the central government, which is the excise duty. So this is the tax. This 15 rupees is the tax which is being paid to the center. Whereas when you buy the raw material, I'm assuming that if you bought the raw material from within the state, this 110 was actually being, this 10 rupees that you actually paid was in the form of state VAT. This 10 rupees that you paid. Now this commodity is worth 106. Now this commodity reaches the next stage. The next stage is that the wholesaler, he says that my cost of warehousing, organizing all these shirts, say is 30 rupees. My value addition is 30. So the cost of the commodity will now become 100 rupees was the raw material, 10 rupees was paid by the manufacturer to the government in form of the tax. Then 40 rupees was the value by the manufacturer, and 15 rupees was the tax. This tax paid is, this 15 rupees is actually paid by the wholesaler to the to buy the product from the manufacturer. So ultimately the value of this product turns out to be this 165 rupees plus 30 rupees is the cost which is being incurred by the wholesaler. So the cost of the product becomes, now the government says that 195 rupees is the cost of the product. You need to pay tax for that, and the tax is 10%. So you need to pay 19.5 rupees. So you add the 19.5 rupees, you will have 218.5 rupees as 214.5 rupees, sorry, 214.5 rupees as the cost. After you have 214.5 rupees as the total cost, now what the government does is now what the wholesaler does is wholesaler sells this commodity to the retailer. Now remember, the transaction here is of a sale, so this tax is again going to be in the form of, as this was a state tax, this was a state tax, was a state VAT. Now next in the phase is your retail guy says that for me the cost is 20 rupees just to pack the product, and then in my operational cost is, so over and above the 214.5 rupees, if you add 20 rupees, you have 234.5 rupees. And if you see the tax on that, that is 23.45. So if you add to this, if you add 23.45, you ultimately end up with a commodity which is 257 rupees, and this is the final cost of the commodity when it reaches the shore of the consumer. And if you see, what essentially is happening is that everyone is paying a tax on the tax that he had already paid. Now how is that? So say this guy is paying a tax of 15, but of that 15 rupees he has already paid one government 10 rupees. And by the way, this tax will be, now if you see, what is happening is that there is going to be tax on tax. What is this tax on tax? When the manufacturer pays 15 rupees, from these 15 rupees, 10 rupees has already been paid by him on the procurement of the raw material. Similarly, when the wholesaler pays 19.5 rupees, is already paid 15 rupees to when he paid 15 rupees to the manufacturer, to the government, to buy this to buy the shirt. Similarly, when the retailer actually, when the consumer actually pays this, when the retailer actually pays this, he has already paid 19.5. So what essentially is happening is there is going to be a, if you see the total, the total here is 100 plus, this is 190 rupees is the actual cost. And if you see the production and if you see the tax amount is 67 rupee. Of a commodity which is worth 190 rupees in the production, 67 rupees is just the tax. To 67 rupee 95 paisa is just the cost to arrive at 257.95. This is how the cascading effect takes place, and this is how the inflation takes. Now, if this is the system, this is the erstwhile kind of system where you're assuming that there is no input tax credit. I'll explain you what input tax credit says is that once you have paid certain output tax, so this 15 rupees, so to say, is the output tax or for the whereas he has already paid 10 rupees a tax on the input that. So ideally what should happen is that you should reduce from the output tax the input tax which has already been paid to come at the actual incidence of tax, to actual value addition of the. So ideally you should have paid a tax, the output tax which is 15 rupees minus the input tax that is already paid of 10. That should be that should have been the actual burden. So that is when you have a clause of input tax credit. Now the problem with the erstwhile system was that the government did not allow that if you have imposed a central tax, the government did not allow that you can also take an input tax credit of the state taxes. So essentially, because you are doing a production job here, you cannot take the input tax credit where the tax has been imposed by the. Had this also been by the central government, you could have used. So input tax credit in the previous system was only limited to the fact that central taxes can only be written off by central taxes. So central duties can only be can provide input tax credit for central tax, and similarly for state. So the state VAT, if you have paid a state input tax, that can only be adjusted for a state tax. That interconnectivity, that interoperability of having one nation, one tax was not. GST method kind of resolves this. Apart from the fact that we are only talking about production. Suppose you have a service sector along. Suppose you are buying this particular commodity. Say this is a particular. Suppose this is a furniture, and this furniture is actually being supplied by, say, a service supplier like. Or now in economic systems, the kind of progress that we have made, it's not easily you cannot easily delineate between a production and a service, because at times the entire production process has both the service aspect and the production aspect. That was the problem with the erstwhile system. Now let us see that how the new system actually overcomes this. To understand this, let's see how the cascading effect of the previous system, which was essentially the tax on tax, has now been resolved by the new system. So if you see the GST methodology, you have taxes and you have input tax, both goods and services. And because you only have three kinds of taxes that I'll also explain you only have CGST, you have IGST, and you have SGST. I'll explain all these three to you. What happens is that now the input tax credit is, because you have uncomplicated the system, this input tax credit is easily available. And because now you will also have a paper trail, that tax avoidance is also good. But let us take this very example that we created to understand that how GST system is actually superior to the erstwhile system. So remember our process in the similar format. Our process, then we had the cost. To the cost, we also had the again tax we are assuming is at 10%. Then we have the actual liability. Actual liability is actually going to be output tax minus input tax. And then you have, so let's analyze this through we had raw material, if you remember, was for 100 rupees. The tax was 10 rupees, and the actual liability will also be 10 rupees. Then you have the manufacturing process. The manufacturer actually adds a value. Now this 40 rupees that he adds is again comprising of three things. The 10 rupees, the 100 rupees as the cost, 10 rupees as the tax, and 40 rupees as the value addition here. So the cost is 150. The tax here is 15 rupees. However, this is the output tax. He has already paid a tax of 10 rupees. So 15 minus 10 will be the tax that he will have to charge on his commodity, and the price that the selling price that is going to be, if you see from the previous example, directly there is a 10 rupee reduction in the cost that is going to go to the wholesaler. Then if you see the wholesaler have a value added of 30, which will increase the price of the product to 185. On this 18.5 rupees need to be paid, but from that 10 rupees and 5 rupees has already been paid. So from this 18.5, which is the output tax, a tax of 15 rupees has already been paid. 10 rupees by the manufacturer to the government for buying the raw material, and 5 rupees has been paid by the wholesaler to the government to buy the manufactured shirt. So essentially the amount that he will add is only going to be 3. If you add this to this, you will have 188.5 rupees as the entire cost price of the product, which will go to the retailer. Now if we see the retailer's point, the retailer do, the retailer will add a cost of 20 rupees. So this product goes on to be 108 to 108.5. Of that, the tax is 20.85, but from that 18.5 rupees has already been paid. So 20.85, 18.5. So you have a tax liability of 2.3. Now you add to this commodity, you have 210.85 as the total cost. So if you see now, what has happened is the same product which was at 190 rupees now has a cost price of 210.85, because of the fact that at each level you have an input tax credit, and the total tax that has been collected is actually 20 point. So this is essentially how the GST system is going to be less cascading. See, what happens is that this system is going to be less cascading. It is going to be less inflationary. This is how we describe inflation in macroeconomics, and this is also how you will reduce the black marketing, black economy, because for me to get benefit of the input tax credit, I would have to give an original bill. So you don't have that kacha bill system, will not be there. So the black economy will also reduce. The inflationary, in fact, will also reduce, and you have an uncomplicated complication. So this is how the GST system actually works in the purpose for my purpose for explaining this numerical was because of the fact that I want you to understand the basics of input tax credit and how this is a superior tax. If we move forward, instead of a center and if instead of a central and the state taxes, what kind of system we have is that under the GST earlier we used to have the central and the state taxes. The interstate is between states you have the tax which is called as integrated, which is collected by the central government. Remember, this is collected by the central government but given to the state of consumption. So this is collected by a center, but this money goes to the state of. So if a product is being sold from if a product is perhaps being sold from say Tamil Nadu to Karnataka, so what will happen is that Karnataka will be the product producing state, whereas Tamil Nadu will be the consuming state. So the tax collected will the whatever tax is being collected will be given to the consumer. The product goes from Tamil Nadu to Karnataka, so the Karnataka government will be the recipient of this tax money. That is why this tax is called destination based consumption tax, because of the fact that tax is being imposed where the product is actually being, as compared to the erstwhile system which we used to have. This system, the VAT system, the VAT system was an origin based tax. Wherever it's produced, the tax. So as you can imagine, some states would have had the issue. States which were actually manufacturing states, like Maharashtra, they would say no, we have a huge manufacturing capacity. For us, this will be a huge loss. Whereas the consumer states will get a lot of revenue. To allay these all these discussions, and to allay all these fears, we had used to have, we have something called as the consumption, the compensation, GST compensation cess. I'll explain you what this compensation cess is later on, but for the time being, all you can understand is that even if after the imposition of GST, if a particular state is losing tax revenue, the center has now promised that it will repay, it will actually pay whatever the difference that the state expected versus what it actually can. So that difference is basically the compensation which the central government. And if you've been reading the newspapers, and I've emphasized this in the class as well, that at times this compensation has not been timely by the central government, because the central government in itself is under a lot of pressure, a lot of fiscal pressure, because the assumption behind a lot of things was that the GDP would be at 7%, 8%. Right now the GDP was at 5%. Now the GDP is expected to go somewhere around 3% now. So if the GDP reduces, if the consumption of item reduces, then the revenues will also reduce, and the compensation amount will have to be higher. So we'll look into the federal aspect of this compensation a little later. However, the interstate tax is in the form of central GST. And so what has happened is, with the coming of GST, the center has now earned the capacity to tax on the retail, whereas the states have earned the capacity to tax, to have revenue, to share revenue from the production side. As I've told you that earlier, center could charge from the production and the manufacturing. That was the authority of the center, while the authority of the states was at the retail and the. So now they have concurrent power, concurrent sharing of revenues. Also, the fact that now the center, now the states can also enjoy the revenue shares from the service tax, which it earlier was not. Because earlier the service tax, except for a little few services mentioned under Article 366, earlier majority of these service tax was being imposed by the center. Now the states have. These are, if you see all your bills, you would have components of CGST. And moving forward to our definition, what we had defined as GST, the very combination of different words. So it's called a comprehensive multi-stage. It's called comprehensive multi-stage. It's because at each stage of these production, these are different stages of production. At each stage at each stage of this production, a tax is being imposed. So at different stages you have tax, and it's comprehensive because it starts from the very beginning of the production production activity to the very end. So it is a comprehensive stage wise. It is a destination based tax. The reason it's a destination based tax, because of the fact that the actual tax happens at the very end, where the consumption, and this tax is only on the value addition, that how much value is being added at each level. So the value addition by the value addition here is probably procurement of the yarn, whereas in case of a shirt, whereas in case of manufacturing it's basically weaving. Then in case of wholesaler, it is the inventory, and in the case of retailer, it's actually the packaging. So at different stages, according to the value addition that has happened here, the tax is. So this is overall the concept of GST. And the other thing that you need to understand from this concept is that this is not on exports, and it is only on imports. So if we talk about our imports and exports, if we talk about India vis-a-vis the rest of the world, suppose sells a product India sells a product. Now remember, this is a destination based tax. If it's a destination based tax, how can India have any authority to tax a product which is consumed in US? So that's why exports are completely exempted. Now, as an economics student, what you can also understand, if the exports are completely exempted out of GST, what will happen? This will actually reduce, and if it reduces the cost of product, it will lead to increasing competitiveness. So our product will be more as compared to, say, if a product comes from US to India. Suppose the manufacturer of the shirt actually buys the yarn from US. So not only will the manufacturer pay GST will be obviously be imposed, plus, and if the US is already giving certain subsidies to its exporter, you will have further duties, you will have additional customs duty, you can have countervailing duties. So this will be added to the custom. So what will happen? The cost of imports will increase, and if the cost of import increases, it actually protects. So this is about the very basic of our discussion on GST. Now what we will do is, after that we have had our discussion on the basics of GST, now we can actually look into the history of it, the evolution of it, and the constitutionality of it. Let us move to the GST concepts and the phases. Now if you see the document which is there in our syllabus, our syllabus says the concept and the status of the report. So what we have to do is page number 3 to 15. Alongside we have to do the page number 48 to 50, and we have to do section 10. So these are the three things that we need to see. So let us look at them one by one. As I've already told you that the Indian tax system, the purpose of this tax system is actually one country. You need to harmonize the internal taxation in the country. And remember, after the introduction of GST is actually a structural reform. And when you read the history of this structural reform, you will perhaps understand that the onset of the philosophy of this tax actually started way back in 2000, and it took us, and we actually had estimated by 2010 we will start this tax, but ultimately we were able to introduce it in 2016. So 2017. So if you see that there has been a long time through which we have thought about this tax, and we have been able to introduce this tax. However, because it's a structural reform, there has been a lot of commentary in the newspapers that the revenues are decreasing, the government is not doing enough. But you need to see that this government has the wherewithal, this government had the ability, this government had the economic architecture in mind to introduce GST. Although what happens was, whenever you have a structural reform, the direct impact is that there is going to be a shock into the economic sector. Firstly, because of the fact that we are very used to an informal economy. Now, in informal economy, you don't have many bills. You don't have that input tax credit kind of issue. Then people are not educated enough that how to file a GST. So, because of all that, we need time. We need some years, probably a couple of more years, when we will have a larger share of the formal economy formalization will increase, and also with this process, the share of the organized sector will increase, digitalization is, and the revenues will automatically stabilize. So there has been a lot of undue criticism of the NDA government with respect to the introduction. However, when we'll complete this entire reading, I'll also tell you that we still have a little complicated GST system. But given that now the ruling BJP has a majority of states and has a majority in the GST Council as well, you will see that the number of kind of slabs that we have right now. We have 4 slabs. We have a 5% slab. We have a 12% slab. We have a 18% slab, and we have a 28%. Apart from that, we have a 40% slab for the sin goods, which is tobacco and other products. Whereas we have a 0% exemption slab as well. We have a 0.5% slab for diamonds. We have also 1% slab. So right now also we have a very ultimately, when we will rationalize this system, we will have only 2 slabs. We will have a merit slab. Merit goods are at probably 12%. We have a demerit good at probably 8, or maybe. So we are only going to have 2 slabs in the coming future. But for now, we have a complicated system because in a federal system there are a lot of things that you need to take care of, which takes adjustment. You have to compensate the states for the revenue losses. So because of all those reasons, we still have a little as if we go through the constitutionality of the indirect tax system, you can see that under Article 267 of the Constitution of India provides that no tax shall be levied except for the authority. And the authority bylaw actually derives from Article 246. The Article 246 has the union list and the state list, where the union and the state lists have this jurisdiction, which is also given in the 7th schedule. And according to these lists, they can tax the subjects which they have under their own jurisdiction. Even before the advent of GST, there was union could have custom duty, the central excise duty, and the service tax. These were the major indirect taxes. Apart from the other taxes that I've already told you, these were the major taxes which the union also used to have what is called as the central sales tax, the CST, on the interstate sales of goods and services. However, the central sales tax, which is now being replaced by what is called as the central sales tax, which was actually imposed by this union government, used to go to the origin. So if a product moves from, as in our example, from Tamil Nadu to Karnataka, this revenue would go to Tamil Nadu. Whereas in the transition, we have a destination based tax. This revenue will accrue, the IGST revenue will be accrued to the consuming state, because the CST was assigned to the state of origin as per the then. On the state side, remember the states still have in GST, if you see, there are a number of items which are still not being included. So what GST does not include, it is not included. B, it does not include the taxes on alcohol. Then it also does not include petroleum, and there are 5 kinds of that. So there are a lot of products which are not included in GST. However, this might later be included the GST Council, but this is not at all included in the GST architecture. So what are the state taxes? State taxes are taxes on sale and purchase. Basically, if you're selling a property, buying a property, or selling any commodity, purchasing any commodity, then you have excise on alcohol. As I've told you, these alcohol, opium, and narcotics, this is completely under, and this is still outside. Then you have taxes on luxuries, entertainment, all of that we have already. Then if you see the evolution, although if we see that, you need to remember that our discussion is also going to include the history of it. So if you see the history of it, that sales tax was recommended by the first committee. There was a taxation inquiry commission under John Mathai, and it said that the sales tax should be used as a source of revenue for interstate taxes, and the interstate taxes was at a ceiling at 1. Now with time the kind of taxes changed. You had introduction of central excise duty, which was in the form of both the specific duty and ad valorem duties. Then in 1976 we had recommended converting all specific rates into ad valorem rates, which ultimately led to what was called as man-VAT. Now all of this history is not very relevant to you. What you can draw is, you can probably draw a timeline, and in this timeline you can have 1950 here, you can have 1976 here, then you have another committee by Chilaya, you have 1991 here, then you have this 2000 committee. So make this form in the form of timeline, because this timeline, understanding the previous tax system is not as important as understanding the current system. So in 1986 you have this as man-VAT. 1986 you had something called mod-VAT. Then in 1991 you had the Chilaya committee on tax reforms, which basically said that that mod-VAT should be included to all capital and all inputs. Basically it talks about input tax credit, that all products should have input tax credit. And in 2000 you have the SENVAT. This only one, all of these taxes that were there were included under only one head, which is called as SENVAT. All these excise and the different taxes that the government had was included in SENVAT. And then you had the service tax being included in 2012. Before 2012 you had a negative list, but after 2012 you had a positive. So apart from before 2012 you had a positive list that only these products can be taxed at 15%, but after 2012 you had only a negative list, whereby certain services were left out. Apart from that, all services will be. After that, similarly you have the coming up of state taxes. You had sales tax in the states, then which was further replaced by sales VAT with time. So you have replacing sales tax with VAT over time, with giving input tax credit, harmonization of taxes. So as you have harmonization of the central tax, you had harmonization of the state taxes. The problem, one of the issues is that we did not have a comprehensive VAT. So essentially, if you see the definition of it, VAT and GST are not very different from. Both are only taxing. But the problem was that in VAT, our tax system was extremely fragmented. Even in VAT, there were a lot of. In VAT, you had these entire central taxes and you had this entire state. And the problem was that if your product is moving from center to so if you're involved in production, the production phase, then you could not use the input tax credit that you have used, that has been there in the production phase, in the retail phase. So that input tax, that seamlessly getting input tax credit across all of these different stages was. Apart from the fact that the VAT system was only concerned regarding goods, now you have services also. So if you understand, GST is a much more comprehensive tax system, whereby all of these central and state taxes are under one umbrella. Input tax credit can be given for any of them, and the fact that the coverage has increased from goods to services. As I've told you, we have one common principle, that it's a destination, it's a consumption based tax. And because of the fact that now there is going to be trails, because if you want that input tax credit, you need to have that paperwork. It will lead to higher compliance, which ultimately leads to the fact that black economy will reduce, which also means that the government's tax revenue will increase, the tax base will increase. So that is how the economy will benefit. The need was that the Senvat, before Senvat, we had multiple levels of excises, that excise and central taxes that had been imposed by the union government. So the purpose was to remove, even for the purpose of introduction of Senvat, was to reduce the cascading burden and expanding the coverage. So this was the purpose, and this is perhaps the purpose for introduction of GST as well. As you can see, both Senvat and State VAT had certain incomplete. Senvat could not be extended to include the value chain in the distribution trade below the stages of production, because this is for the production phase, this is for the distribution and retail. So a distributor could not take advantage of the tax that has been paid by the manufacturer during the production phase. So that interoperability, that seamlessness of one nation, one tax, apart from the fact that states also had other different kinds of tax. So a state might first impose state VAT on a particular commodity, and lower down it can also impose octroi, it can also impose cess or surcharge. So one kind of state tax would not be able to get input tax credit for any other kind of state tax. So that kind of a problem was also there at the state level. Now, CST was also sort of distortion, because ultimately it goes against the principle of the fact that actually the tax revenue should actually go to the state where because that is the state where actually consumer is, and which is ultimately the purpose of an indirect tax. The burden ultimately shifts to the lower down level, and which is the last level. The last level is the consumer level. It is a consumption tax. Whereas in the erstwhile system, we used to give this entire money to the origin state, the exporting. So this is the reason why we had this. As I've told you, that the discussion of GST actually started with the alongside the FRBM and the Kelkar committee, and it talks about a complete goods and services tax with complete set off for the entire process in all stages of production. That's why I say that it's a comprehensive multi-stage. Then this is the history. If you're interested in reading the history, that what happened, what was the discussion, you can. The challenges, this is the important part. The challenges is the origin versus GST being a destination based consumption tax. The tax revenue will accrue to where the consumption actually takes place, whereas the existing VAT was a regime based on origin principle, where CST was assigned to the state. So the manufacturing states expressed concerns that we will lose revenue. However, this line of reasoning was that if this money is not given, then the location of exports would not contribute to the exporting state. But the fact that the center said that if there is any shortfall of revenue, we will have the compensation for 5 years. If you have any loss of revenue because of GST, we will compensate you. So, and the assumption there, I'll also talk about the assumption there, that what is going to be the assumption. However, the economy is doing well if you're producing more automatically, and if the cost of the production goes down, overall the demand in the economy will increase, and because that base will increase, the exporting state will automatically do well. So the extent of consumption expenditure is also depend on the level of income of the residents of that particular state. And because of the fact that this is going to increase the income, because their production will increase, because of the fact that the goods will now be cheaper. Because of that, you have additional revenues and you have additional export output. The base of your taxation will increase, and that will automatically lead to. The other is that the rate structure and compensation, whereby there were uncertainties about the gains after the implementation, and it was said that that whatever you will lose will actually be paid by the center. So therefore you had something called a revenue neutral rate, which the government proposed. Under the revenue neutral rate, the government said that we will have one rate through which the government will actually, this was the rate the committee recommended, a revenue neutral rate of 15.5 to 16% to 15%, and the demerit goods to be charged at a further higher rate. Now, with this, what the government essentially was trying to do is that with this tax rate, the revenues which the government will which the government will have will be approximately the same as in the previous system. So that's why it's called revenue neutral rate. Revenue neutral rate is basically whereby the revenues for both the state and the center will perhaps not. Therefore, the dispute settlement, you have this you have the GST tax council for this. Then this is an important discussion, that the state governments actually receive a lot of revenue from alcohol for human consumption and for petroleum products. So if these are included under GST, then the states do not have autonomy over this revenue. So their loss over revenue will be much more. So because of that, the constitutional the kind of bill that we proposed was that only alcohol was kept out of GST. The petroleum products, the 5 petroleum products, which is crude oil, high-speed diesel motor or petrol, ATF, and natural gas were actually included in GST. However, they will be recommended by the council at a later. Also, the central government retained its power to tax tobacco and other products, though these are also broad. This is the history that what has been done. This is again not the part of the course. If we move further to what we have to do, we have to see page number 36 to 44 and the last, the design. If we see the design of the taxes, now under this model, the tax will be concurrently done by the states and the center with a common base. So if you see a restaurant, the price of the commodity will be 100. So suppose you bought, and on that particular base, it will be the same common base on which you will have, if it's 5%, you will have 2.5%, and you will have 2.5% as GST. So you will have 2.5 rupees here and 2. So now under the dual GST model, you will have the states and the center will have a common base, which is the cost. IGST, as I've told you, that the interstate supply of good, will be integrated to the GST, and the center will levy. I told you the center will levy the integrated GST, which would be CGST plus the SGST on all inter-supply state of goods and services, and this will be available, and this IGST value addition will be available as input tax credit as well, and this will be available to the state where the consumption happens. So IGST will also be available for input tax credit, and this will happen in the state of tax rates. Tax rates, as I've already told you, that these are the 5 basic rates, but apart from that, you had a 0, you have also 0%, you have a 1%, you have a 3%, you have a 4. So you have these exceptions, but these are the 4 bases. But with time, as I've told you, with time, what we will have is actually we will have a 12% and an 8. We are only going to have 2. This is normal goods, and these. So we will only have these are merit. We will only have 2 slabs, but right now we have 4 basic slabs. But apart from that, as I've told you, that cess is being imposed on tobacco products, and that cess that has been imposed. So the central government imposes cess on these sin goods right now, And with the sin goods, what it does is that the cess is called compensation cess. This is called compensation cess. So this money which the government is keeping, this money which the government, the center which is applying this cess, this money is actually being kept for compensating the states for the revenue loss that it might have because of GST. Now, what is this compensation? Now, suppose a particular state has in the year 2017, it has a state revenues, indirect tax revenue of 100 rupees. The center says that we are assuming a 14% increase in your revenue year on year. So next year it will become 114. So this was your 2017. This particular state does not get 114 rupees. Suppose it only gets 107 rupees under the. So this deficit which the government is saying, the 7 rupees will be paid by the center from this compensation fund to this particular states to compensate for the loss that it has had, and that is the entire discussion. So from the year 2015-16, it is, that is the base year. The growth rate of a state for the 5-year period is assumed to be 14%. Now you have the e-way bill. The e-way bill is basically introduced so that you have seamless transfer of products from one state to another state without these trucks being stranded at the state border to get these entry taxes and the which is also called the octroi taxes. So e-way bill is a self-declaration model whereby the producer declares that this is the value of my commodity which I'm sending across the state, and this is the amount of tax that the. Then you have an anti-profiteering mechanism, although that's not very important for you. Then moving on to our discussion on the last part, which is the benefit. As I've told you, the benefits is the benefits to exporters, whereby the prices, the competitiveness of Indian goods will increase because there are no taxes on this. Then the entrepreneurs will also have, because you will not have multiple registrations if you have if you have a small limit. Then you have a different aggregate annual turnover, and then you can pay a comprehensive kind of a tax rather than a segregated tax. Apart from that, benefits to consumers, there's no going cascading effect. The inflation is going to go to reduce, and then because of the kind of tax avoidance that is going to reduce, the tax base and the tax revenue for the economy will increase. And because of the fact that it is going to have one tax across one country, unified common market will be achieved. So the prospects of Make in India will also increase. And as I've told you, that because of this, the ease of doing business of India will increase, because this is a structural reform, and this is one of the major reforms because of which India's rank has now increased. So this has been our entire discussion on GST. I hope you understood all of this. Please go through the PPT. I'm going to send you the PPT also. I've already sent the this PDF. I hope if you have any questions, you can always ping me on WhatsApp. I'm signing off, and I request you all to stay and to follow the lockdown. Thank you very much. Bye bye.